Hey everybody, Marty Mazur. Good morning, August 23rd, 2018. Updating you this morning on the state of the market. In front of you is the chart we've dubbed our correction chart. Created this back here when the market bounced off of what became officially a correction. It was over 10% decline, quite precipitous one from January 26th down to February 8th. Came back, tested it, succeeded or passed that test, found this resistance right here where we could establish a downtrend. Came up, tested it, succeeded, just needed one test there, and we were more or less off to the races. I told you when I first ran this that the average 10+% correction throughout history took 209 days to get back to its previous high. And sure enough, we are right on that track for this correction to be really nothing more than the average, if we can get to new highs right about here. Now, on an intraday basis, yesterday or day before, we actually got there, but this is on a closing basis. So I wanted this morning to help you kind of put this in perspective. This, of course, is the Standard & Poor's 500 index. We use it because it is the preferred benchmark for the U.S. market among institutional investors. There's also, of course, the Dow Jones Industrials or the Dow Jones Industrial Average that everyday folks, the retail investor, if you will, pays attention to. You hear in the news, the market is up 100 points, down 100 points, etc. But the thing about the Dow is that it's only 30 stocks versus the S&P 500, which is 500 stocks. Both of them capture very large U.S. companies. So in that respect, the S&P 500 even lacks because you get no small cap exposure, mid cap exposure, no non-U.S. exposure. You just have large U.S. companies. The S&P 500 is capitalization weighted, so Apple has a much greater influence on the average than the smallest large cap does. Dow Jones Industrial Average, interestingly, is price weighted, so it's actually the price of the share of stocks. So the higher price stocks actually move the market around. So those are two interesting differences as well, but primarily it's the concentration. So frankly, the Dow being so popular, I find myself every day talking about the move in the Dow. Clients relate to that. Really the S&P is better, but I'm going to take it one more step and give you what is probably the ultimate benchmark for a good quality, well-diversified portfolio. But I wanted you to notice here that the Dow has a ways to go before it actually gets to where it was its all-time high back here on January 26th. It actually came and corrected starting the same day. It actually failed the test here and created a lower low before it began to establish its uptrend. Once again, looking at the Dow, looking at the S&P, acknowledging that they lack in terms of breadth and diversification. I wanted to talk this morning about the New York Stock Exchange Composite. Clients, when you come in for your reviews, we show you the NYSE Composite. We do show you the S&P. We show you the Developed Markets Index from MSCI, Morgan Stanley, and then the Emerging Markets Index from Morgan Stanley. It's really the NYSE Composite that kind of takes the best of all worlds. In fact, here's from Investopedia. The NYSE Composite Index is an index that measures the performance of all listed stocks on the New York Stock Exchange. It includes more than 1,900 stocks, 1,500 of them U.S. Its breadth, therefore, makes it a much better indicator of market performance than narrow indexes that have far fewer components. And as you can see, the NYSE Composite has quite the ways to go before it makes it to its all-time high again back on January 26th. It had a very nice run. There's two key differences that are really impacting returns negatively so this year for the NYSE when you compare it to the S&P 500. And that is the S&P 500 is currently heavily weighted to technology stocks. And of course, there's no foreign allocation there. Here, we've got 400 of the stocks in the NYSE Composite that are actually American depository receipts, which are the way you trade foreign equities on a U.S. exchange. So we think that the NYSE composite is the better indicator of the three, and certainly of the two that we feature in our performance reports. And we don't think so because it's underperformed, and our portfolios by and large this year have done better than the NYSE, and they haven't done as well as the S&P 500. And quite frankly, it's only at the performance reviews where we even think about this or care. Our job is not to outperform an index, it's to keep our clients' portfolios smartly allocated at all times. But in our business, you run into this benchmarking, people talk about it, people brag about it, and so forth. So I thought today, in case any of our clients run into that, I want to give you what I believe to be the proper perspective. Now, when we look at the two indexes, and this is a ratio chart, this is the NYSE Composite Index compared to the S&P 500. When this line rises, the NYSE Composite is outperforming the S&P 500. When it falls, it's underperforming. And the period I'm showing you here is actually the beginning of the 21st century. It's January of 2000 to just past the market peak in 2007. And as you can see, a broad-based portfolio, the early part of the 21st century, was huge. There was a dramatic outperformance of the NYSE over the S&P 500. Since then, however, that has not been the case. Since then, the NYSE, while it hasn't had negative returns, this just shows the underperformance of the NYSE relative to the S&P 500. So we've experienced such a long period of underperformance by a broadly based index. Why not get more concentrated? Why not take more risk, or so to speak? Why not have a more concentrated portfolio if it gives you such a better rate of return? Well, again, that's not always the case. Remember, the first 8 years of this century, we saw a huge outperformance of a broad-based, well-diversified global portfolio. Concerns about the S&P 500 really revolves around its very high allocation to technology stocks. Notice here in 2018, where I'm circling it with red, 26.37% of the index is in tech stocks. If you go back, the last time we had something that high or higher was 1999, and that preceded a period where tech stocks, if you look at the NASDAQ composite, suffered an 80% decline. Now, I want to be clear, this is the only real correlation I can draw between this period and that for tech stocks. Right now, we have tech stocks trading at about 20 times next year's earnings, and that's not historically something to be afraid of when we look at valuations and so forth. It is on the high end relative to other sectors, but it's not the huge multiples that we had back here in 1999 with all the dot-com stocks and so forth. Another thing I find very interesting with this chart here is, remember, of course, the last bear market was all about. It was all about stress in the financial sector. So here in 2006, just before everything fell apart, and later in 2007, the S&P was 22.27% in financial stocks. Fast forward to today, it's 13.93, and financials are trading at 12 times earnings. And ironically, currently it's financials that are our top weighting. We have a little less exposure. We lowered our exposure, our target, to tech a little bit at the beginning of this year. We're still there. We still like the sector, and it's been great this year, and that explains why the S&P 500 has done so well relative to most portfolios. But I do not like the risk-return trade-off here. I do not feel as comfortable owning tech with these multiples, with the trade issues that are out there, with the potential for a continued stronger dollar. I certainly like it enough right now to have 14% exposure, but I don't like it enough to have as much as financials. So again, folks, in closing, we have the NYSE composite, well-diversified global portfolio that we think carries a lot less risk than the S&P, with quite a ways to go to the all-time high. In fact, I would argue that the market is not anywhere near the January 26th high. But when we're looking at the S&P, which is largely explained by that big weighting to tech stocks, we're almost there. Thank you, folks, as always, for watching and listening, and I'll talk to you again very soon. Take care.